Hey guys, welcome back to the channel. Today I'm going to defend one of my favorite YouTubers, Joseph Carlson.
There's a lot of people out there trying to convince others that it is virtually impossible to beat the market.
He recently released a video explaining why you can beat the market. And as predicted, there were a lot of Bogleheads who got extremely mad at this. So today I want to go through a video trying to attack Joseph Carlson for his beliefs on the market and explain why this guy is talking absolute nonsense.
So in this video, we're going to react to this amazing shilling of individual stock picking by none other than YouTube's large cap tech past performance buying hero clown, Joseph Carlson.
In case you weren't aware, Bogleheads are people who follow the teachings of Jack Bogle. He was a historically famous investor who founded Vanguard and believed that low-cost ETFs that passively track the market were the best financial option for individual investors to invest their money rather than investing into costly mutual funds or picking stocks themselves. But as with any ideology, there's always a minority of people that take it way too far, thinking it's physically impossible to beat the market over a long time frame. And I'm sure these people probably run out of a room screaming in fear whenever they see a picture of Warren Buffett or Charlie Munger. But it's not just Warren Buffett that has beaten the market consistently. It's the average individual investor. For the last 10 years, the average individual investor has beaten the S&P 500 by a significant amount. Now, I know this graph will have driven some of the Bogleheads crazy and they probably closed the video by now, but let's get into the juicy bits.
So let's go ahead and react to this freaking doofus, right? Oh, I got spiky hair like I'm in a boy band. Yeah, you're so freaking cool. You're such an icon, Joseph Carlson. And see what he has to say.
So we've already started the video and we're already getting into spiky hair slander. That is not all right in my opinion, so make of it what you will.
Segment of the market that has convinced themselves, and they're trying to convince others, that it is virtually impossible to beat the market. And by the market, they mean the S&P 500. Their claim is that as an individual investor, if you're picking out individual companies, creating your...
Well, first of all, the S&P 500 is not the market. The market is every stock in the freaking world, you clown.
The first point I want to address from Strongman Finance is him saying that the S&P 500 is not a good benchmark to use when comparing your individual investments. Well, in my opinion, that is completely wrong. The S&P 500 has outperformed a global benchmark like VT over decades now. So by Joseph Carlson using the S&P 500, it's actually a harder benchmark to beat than something like VT.
Outperform it for a month or a year or 2 years, well, you basically got lucky, or you took on a lot more risk and you just simply got lucky. And the people that have beat the market, the outliers, the pros, people like, well, Warren Buffett, they were just super lucky. They're one in a million. They're one of a kind. And you're not one.
Yes, statistically, over long time horizons. I've never said you can't beat the market in a year. You will underperform the market over long time horizons. The frickin' professionals can't do it. But you think this freaking dork right here, with his ball trim software and his spiky hair and his little sign in the background and his large cap tech buying butt, do you think this guy is going to teach you how to beat the market? But I know somebody that beat the market over the long run, so that means it's very likely that I could beat the market. How many people have beat the market over 30, 40 years? Very, 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 very few.
So as predicted, Strongman Finance has basically said that Warren Buffett is a 1 in a trillion miracle that's never going to be repeated and you shouldn't even bother trying. Now, I agree that beating the market is a very difficult endeavor and not everyone's going to do it. Most people will fail. But the reason you haven't heard of more people beating the market is because the majority of them are individual investors, not active fund managers and not the professionals. Why is that? Well, individual investors aren't playing the game with their hands tied behind their back. That's exactly what active fund managers have to do. Their funds receive the most cash when the market is at its highs, which means that's when they have to buy more stocks. They're having to buy high, and then they then receive the most stock or cash outflows out of their funds when the market is low or when it's crashed, which means they have to sell their stocks after the market has crashed. They have to buy high and sell low. Almost by definition, it's impossible for them to avoid that. In addition to that, they can't buy the kind of stocks that will outperform the market reliably, like large cap tech, because they'll receive criticism exactly like what you're accusing Joseph Carlson of, picking big tech stocks which require no skill and are just obvious buys. Well, that's exactly how you beat the market.
Warren Buffett. So don't even try to be Warren Buffett. Don't try to pick individual stocks. Their advice.
You're not Warren Buffett, you freaking clowns. You probably have a full-time job. Joseph Carlson's full-time job is pretending like he has an edge on the market by buying large cap tech. What a freaking loser. And convincing you to buy his ball trim software and to watch his YouTube channel so he can get ad revenue. That's the whole purpose of his freaking channel, okay? He has a fake job. Most of us have real jobs. And when you have a real job, you don't have time to pick stonks, okay? Especially if you have a family. Doesn't he have a kid or something? How do you have freaking time? I'm struggling to understand.
Yes, time constraints can be a big constraint if you are investing into individual stocks, as you need to keep track of all of the stocks that you're invested into on at least a regular or semi-regular basis. But me and Joseph Carlson have always said that if you don't have the time or desire to do the research and look into individual stocks, then you should settle for low-cost passive index funds. And that has always been the best advice for those kind of people. Although I might add that if you are able to make a YouTube channel and make videos, then you probably do have time to look into individual stocks if you want to.
Because at the end of the day, if you buy individual companies, you're basically gambling. You don't have the skills, you don't have the ability to tell what direction a stock is going. That's the art.
You don't, because it's based on future events, you clown.
The thing I'd like to address is the idea that past performance cannot be used at all to predict the future. And whilst it's true that past performance can't guarantee the future, I definitely think that it can predict the future, or is at least somewhat highly correlated with the future. If there's a company with a great business model, great finances, a great valuation, and no competition, and it's performed really well in the past, why wouldn't it perform well in the future? The exact same thing is true with kids in a school. If you ask any teacher, which of these kids do you think will go on to do the most things in life, I guarantee you the vast majority of teachers will be able to predict which kids will go on to do well. Sure, some of those kids might end up becoming a drug dealer or a crack addict or so on, but the vast majority of them will live out to fulfill their potential. Like it or not, past performance does predict future performance the majority of the time.
But what I reject is their notion, their idea that investing in individual companies is akin to gambling, that nobody can realistically outperform the market, and the idea that if you do so, you're simply just lucky.
You're not going to outperform the market. To beat the market, you need to have extra information that the market doesn't know. We live in the digital age. Computers can send information instantaneously. When a company announces earnings, do you notice you see a vertical line going up or down a lot? You know why? Because the information is processed so quickly that the market can react almost instantaneously to earnings. Do you think you have time to react to earnings as fast as the market does? Of course you don't. The market has an edge over you, you freaking doofus.
Now he's saying that the market is fully efficient at all times, that every single piece of data about a stock is priced into that stock at any given moment in time. That's the efficient market hypothesis, and in my opinion, it's completely wrong. The market trades based off human emotion or bots that are trying to predict human emotion and reactions to stock news. And that doesn't constitute the fair value of a stock. Just look at Meta stock. At the end of 2022, it was worth a quarter of what it was worth at the end of 2023. Is that efficient? Well, no. You can outperform the market by buying a stock when it's oversold and undervalued.
One of the biggest arguments that they use to discourage individual investing is the idea or concept that only a couple companies are responsible for the majority of returns in the stock market. And unless you pick those few companies by either skill or luck, you're going to be left behind. The 7 companies driving the US stock market rally. Now pay attention to that. There's only 7 companies that are driving this market rally.
Yes, because they're large companies, they are more represented in the index, and they have had good returns year to date.
Now, if we look at the article, we have the 7 companies right here. It is, of course, the Magnificent 7.
And of course, he's invested in those. What a freaking shock.
I'm not sure why he's criticizing Joseph Carlson for owning some of the Magnificent 7. After all, these are the stocks that drove the market last year, and if you own them, you probably beat the market. So why wouldn't you own the Magnificent 7 if you are trying to beat the market? Surely if you own them, it's a sign that it's pretty easy, that it's easy to beat the market because you're just invested into the best stocks, right?
So what are the odds we have of picking out those few companies? It seems impossible. It seems like a daunting task. Do we really have the skills to select only a handful of companies that are going to outperform?
No.
Looking at this is extremely discouraging as an investor. Investing in individual companies is like trying to find a needle in a haystack, but buying the index is like buying the entire haystack. That way you are guaranteed to have the needle in it. That's the analogy they give. Well, what if I had to say that this entire concept and this analogy of finding a needle in the haystack is entirely false? First of all, we can start with just this year. We'll look at the S&P 500's performance this year. You'll notice that year to date, it's up 19.45%. Let's go ahead and take a look at the needles in this haystack. Right here, we have the S&P 500 component returns year to date.
Year to date. Year to date. He is looking at a 1-year time horizon to prove the point that over long time horizons, you're not going to pick the long-term winners. What a moron.
Let's go ahead.
So Strongman Finance does, in fairness, have a point here. Over time, the number of stocks that are driving the average market return narrows so that over a decade period, the number of stocks that beat the average might only be something like 15%. But when you're picking stocks, you're not just picking stocks at random. Warren Buffett didn't just throw darts at a dartboard and buy all of the stocks that it landed on. But I don't think it's impossible to identify companies that will have better than average performance in the future just based on their financials, their growth story, and their track record of providing returns to investors. Back in 2010, anyone could have told you that over the next decade, big tech, Google, Microsoft, Facebook, and so on, would do great. And sure enough, they absolutely destroyed the market. Strongman Finance himself is making fun of Joseph Carlson for owning big tech directly, even though big tech is what's driving his index fund returns. So what's the logic in that?
This one is another needle. So far we have 3 needles that have not just beat the index, they've gone up double, triple, quadruple, quintuple over the index. These are massive outperformers. They've gone up in orders of magnitude over the index. We have Royal Caribbean, the cruise line, that one's another needle. We have Holt Group, 93%.
You can't, year-to-date returns are so manipulative. Okay, first of all, a stock could drop 90%, which is down, so you go from $100 to $10, and then it goes up 200% in a year or two. You're still well below the original price. Year-to-date returns are freaking useless. It's all about long-term performance, which is your investment life. 30, 40, 50, 60 years, you doofus. He's assuming that you buy these stocks right on January 1st or 2nd when the market's open. God.
Studies have shown that between 1923 and 2009, only around 25% of the stocks actually drove the positive return of the Russell 3000. But if you exclude the bottom 25% of those stocks, then the returns would be far, far higher. Yes, if you exclude the top 25%, the returns would be negative. But if you can concentrate your stock picks in the best quality companies, then your returns can pretty easily beat the average return of the market.
100 companies, and we're still above the S&P 500's returns year to date, which is 19.45%.
Wow, your chances are really good. The top 23% every year. It's so easy, bro.
We try to tell you that there's only a tiny select few of companies that outperform. But we're looking at the numbers, and typically, on a typical year, 40 to 50% of companies outperform the overall index. 40 to 50%.
On a typical year, numbnuts, a stock could drop 90% and then have a small rally that still doesn't recover initial losses.
Is not a tiny sliver. That's a big chunk of companies. That's hundreds of companies in the S&P 500 every single year.
Oh, if you're just an analyst, so you get up in the morning, you take your kids to school, you go to your job, you come home, you hang out with your kids, you make dinner, You hang out with your kids some more. You put them to bed. Oh, it's 7:30, 8 o'clock. Time to do my stock analysis. Let me put on a Joseph Carlson video where he talks about large cap tech. Yeah, you're a freaking analyst, you doofus.
Now he's saying that it's extremely difficult to pick stocks. You're going to have to spend hours and hours of analysis every day just to pick the right stocks to invest in. But just a moment ago, he was making fun of Joseph Carlson, saying that he's a mega genius for picking large cap tech stocks and that anyone could do that. So could anyone do that? Or is it extremely difficult? So that pretty much summarizes most of Strongman Finance's arguments against Joseph Carlson and beating the market. And I think he's so wrong on so many different levels. I just wanted to make this video to explain why. Personally, I think you can beat the market if you do the due diligence, you do the research, and you have time to do all of those things. If you don't, then low-cost index funds are a perfectly valid way to invest your money, and I don't look down on anyone who does so. But personally for me, I have the interest and time to invest into individual stocks. If you're interested in the kind of stocks I invest in, please check out my other videos and subscribe if you want to see future ones. Thank you for watching the video, and I'll see you guys next time.